the tax bomb in your retirement accounts and how the Roth IRA can help you avoid it. This episode is going to be chapter 3 of my new book, The Tax Bomb in Your Retirement Accounts and How the Roth IRA Can Help You Avoid It. And that's going to be called Don't Get Sucked into the Widow's Tax Trap. Now, I do have another video right here on my YouTube channel about Beware the Widow's Tax Trap. And that's a simple amount what we're going to talk about here today from my book, The Chapter 3. So what I want to share with you, so don't forget to subscribe, my friends. If you like what we see here, what you say here on Heritage Wealth Planning YouTube channel, I think the subscribe button is on that side. So click that tiny little red subscribe button. And then if you do, hit the notification bell to be notified for future content, because we're doing over a video a day here now. The first and foremost, I got a bunch more chapters due from this book. And I'm going to show you exactly where you can get it. And there it is. Go to Amazon.com. You type in Josh Scanlon, and you're going to see it right there. Boink, and there I am. And these are my 2 books I have up there so far. Again, Kindle Unlimited is 0. Kindle Unlimited 0. For the Kindle version is $4.49. For the Kindle version is $4.49. And for this hard copy version, it's I think it was $5.99 actually. That's what Amazon priced it at. So that's good. So it's very, very cheap. So go ahead and get it. All right, so let's go to the third chapter of the tax bomb in your retirement. The second chapter, the tax bomb in your retirement accounts. Don't get sucked into the widow's tax trap. All right, so what we're going to talk about here is that a married filing jointly couple, unless they die simultaneously, will not be married filing jointly taxpayer indefinitely. At some point, you or your spouse will be a single taxpayer, and your situation is going to change dramatically. And before we use John and Judy, we're going to refer to John and Judy quite a bit here. So right now we got John and Judy. They have $100,000 of income, which consists of John's military pension and IRA distributions. All right, so we got IRA distributions, $45,000. His military pension, $55,000, which means their AGI, adjusted gross income, is $100,000. They're over 65, so you take off their 2 standard deductions, and that's their taxable income, which means their federal tax burden is $8,400. All right, so that's what we're looking at: $8,400 in taxes due on $100,000 of gross income, from which is derived from IRAs and pensions. Now we're going to say John gets hit by a bus. Now, in the military, you have something called SBP, Survivor Benefit Pension, where you basically pay, I think it's like $250 a month or something like that. And that will ensure your surviving spouse gets 55% of your benefit. So in this case, Judy will receive $30,250 from John's $55,000 military pension. But Judy needs $75,000 to live on, okay? So she needs $75,000 to live on, and so the rest of her income is going to come from IRA distributions. Now, as I say here in the book, we're not talking about Social Security at this chapter, but don't worry, we will, and that's going to get a lot of fun there. So now Judy's IRA, or her income, is going to look like this. She needs $75,000 gross, of which she's going to get $30,250 from the survivor benefit plan of John's pension, and she's going to take the rest from IRA distributions, and that's going to get her AGI of $70,000, $75,000. With her 1 standard deduction, she has $13,300, which means her taxable income is $61,700. Her tax is $95,13. Anything jump out at you? Tax $95,13. Tax up here is $84,26. Taxable income is $61,70. Taxable income is $73,400. And yet, lower taxable income, in fact, 33% less total income, because she's only got $75,000 of AGI, where they had $100,000 up here. Lower taxable and significantly less gross income, and yet 13% more in federal taxes, my friends. And I say, how can this be? And we're going to show you how the tax brackets work. So here is a single taxpayer. She's in a 10% tax bracket with taxable income at basically right under $10,000. She's in the 20 to 12% tax bracket from $9,525 to $38,000. And then she's in the 22% bracket on $38,701 of taxable income. And so if we go up here, we see her taxable income is $61,700. And we come down here, $61,700 puts her in the 22% bracket. Let's go up here, though. What was John and Judy's taxable income? $73,400. What's their tax bracket at $73,400? It's still 12%. So not only does Judy have less income, significantly less income, but she has higher tax brackets because she loses a standard deduction, which means not only she has less standard deduction, she has higher tax rate, she has more taxes, even though at the end of the day, she has significantly less income. And that, like I said, is the widow's tax trap. Part and parcel. Less income, less standard deduction, higher tax bracket, higher income. A higher income tax. That's all there is to it. Again, I just cannot stress this enough. This is the widow's tax bracket, tax trap. $9,500 is her tax due, even though her taxable income is only $61,700. When she was married with John, $8,400 was their tax due, even though their taxable income was $73,000. It's crazy. It's just a tax code. That's the tax code. Now, what happens if she took it from a Roth IRA? If she had Roth IRA distribution, she had $44,750 from a Roth. Her adjusted gross income is what? Just from that pension. Standard deduction is $13,300. Taxable income is $16,950, and her tax due is only $1,844. So the question that comes into mind, she would save $1,844 minus that right there. So what's that? That's about $1,844. So we break out our. I'm going to go back to me now. We're going to break out our trusty 1844, 9513 minus 1844. She's going to save $7,600 in taxes because she had the Roth IRA as opposed to a traditional IRA. So how much did they save in taxes, John and Judy, when they contributed to their 401k, tax deferred 401k, or tax deferred traditional IRA? I don't know, but it's not $7,600. If they did not save $7,600, they lost money. No other way around that. Now, as we go through in other chapters of the book and we start throwing Social Security into the mix, and then Medicare is even going to get worse for Judy as well. That is the thing with the Roth IRA, my friends. Just because you're looking at tax bracket today versus tax bracket in the future, you can't. You got to look at your taxable income versus with your standard deductions today versus those projections in the future as well, plus your Social Security tax, plus your Medicare tax, Medicare premiums, plus the reduction in standard deductions, plus the increase in taxable income because of tax bracket. As you're a single taxpayer, you're in a higher tax bracket with the same amount of income as a married filing jointly couple. The widow's tax trap, right there. The widow's tax trap. Watch out. All right, so that's chapter 2 of the book, and we'll do chapter 3 here just in 1 second. I'll have the same shirt on. So if you like what you see, subscribe, notification bell, thumbs up, always helpful. Comment down below. Share the videos with your friends, neighbors, and others. And then don't forget to go to the blog at heritagewealthplanning.com, heritagewealthplanning.com for all the other content on podcasts, other content on just blog posts, and everything that's out there you can see as well. We'll see you next time. Thanks, guys.